Welcome everyone, and thanks for joining us for our mid-year webinar as part of our Beyond Insights series. I'm Justin Wheeler, CEO of Berkadia, and I'm joined by Berkadia President Randy Jensen and former Vice Chairman of the Federal Reserve System, Randy Quarles, for a U.S. economic update. The capital markets landscape continued to face headwinds throughout the first half of 2023. We all knew persistent inflation and rising interest rates would continue to slow investment activity this year. Market forces like deglobalization, the resurgence of onshoring and nearshoring, demographic trends, and geopolitical concerns are all contributing to elevated and persistent inflation that is not likely to be resolved in a matter of months. We believe this pattern will continue, with interest rates remaining higher for a longer period of time than we all might wish. Looking at multifamily fundamentals, the multifamily sector remains a favored asset class by many investors due to underlying fundamentals as well as long-term projected economic and demographic trends. The pace of apartment absorption is picking up again in 2023 after experiencing a significant slowdown during the latter half of last year. Despite a historically high absolute number of new units coming online, leasing activity is gaining momentum as inflation, including rent growth, is gradually stabilizing. Despite an elevated supply pipeline, annual rent growth and year-end occupancy are expected to be near or higher than the pre-pandemic averages. In the capital markets, according to MSCI, the pace of declines for total returns of U.S. commercial real estate sectors improved at the start of this year from the fourth quarter of 2022. The apartment sector remains the largest and most liquid portion of the commercial real estate investment market in the U.S., and multifamily sales have accounted for a third of all transactions this year. With the cost of capital increasing, cap rates have been steadily increasing. However, the average cap rate in the multifamily sector remains the lowest among all U.S. commercial real estate sectors. I've been recently asked, what do you do? My response has been, I run an appraisal company. Sponsors and lenders continue to struggle to pinpoint valuation, and that has chilled transaction activity. Anecdotally, we have seen some movement in bid-ask spreads recently, with green shoots starting to pop up, and some deals are getting done. As usual at this point in the cycle, private investors are dominating investment activity. Institutional investors are mostly on the sidelines dealing with redemptions, rebalancing portfolios, or waiting on further stability and transparency. In terms of cross-border capital, many institutional and family office or private capital groups have dry powder, with some eyeing U.S. real estate, and more specifically the living sectors. Through our newly formed strategic alliance with Knight Frank, we're connecting with a more diverse base of investors around the globe, looking to the U.S., which we feel will have a profound impact in driving greater returns for our clients. Lending conditions continue to tighten, no one's surprised. Construction financing for anything CRE, even ground-up multifamily, is largely non-existent. Agency lenders continued to hold their position as the largest source of financing for the multifamily market, but even they aren't leaning forward to provide liquidity the way they ought to, at least in my opinion. Capital raising in the value-add and opportunistic space continues. We're seeing more investors raise funds to acquire distressed assets or fill gaps in the cap stack by providing preferred equity and mezzanine debt. We don't see this need slowing down anytime soon. Amid the rise of a wait-and-see mentality across the industry, at Berkadia we found supplying investors with real-time, data-driven insights helps to inform their portfolio strategy and sustain anticipated returns. This webinar is just one example of how we're delivering on that. So without further ado, I'll turn it over to Randy Jensen with our special guest.
Welcome everyone to our Beyond Insight series here at Berkadia, and we are very fortunate today to be joined by Randy Quarles. Randy has a very distinguished background. I'd like to just take a couple minutes and embarrass him over some of his accomplishments, because they're quite remarkable and relevant to the topics that we're talking about here. So Randy received his undergraduate degree in philosophy and economics from Columbia.
That's right.
With some distinction, the highest distinction. Yale Law School, another slacker organization. And after that, you went into the practice of law. Tell me a little bit about that at Davis Polk.
Yeah, Davis Polk is one of the main financial law firms on Wall Street, and I was a lawyer there for almost 17 years in our New York and London offices, and became the co-head of the financial services practice by the end of that time. So.
Right. an intermittent in your time at Davis Polk. You did a couple of stints at the Treasury Department.
That's right.
Talk a little bit about that.
Yeah. So in the, in response to the savings and loan crisis of the late 80s, the Bush 41 Treasury put together a team of sort of folks. They had an academic and an investment banker. The investment banker was Jay Powell. They had somebody from the Hill, and they wanted a sort of technical lawyer to come join the team in the most junior slot, which I was in the late 80s. And so I went to the Treasury and then came back to Davis Polk. So I was in the Treasury for 2 or 3 years in the Bush 41 administration, responding to the savings and loan crisis, and then went back as a partner at Davis Polk until they called me back into the Treasury in the Bush 43 administration in 2001.
So talk to me a little bit about that. But even before you went back to the Treasury, you did a stint at the IMF. Was that right?
Yeah, I mean, so the U.S. representative to the IMF is appointed by the Treasury. So the first role that I had was as the U.S. person at the IMF, sort of an ambassador type role. There's a board of directors of the IMF that, representing the countries that are members of the IMF. And then I was brought in as an assistant secretary for international affairs, and then became the undersecretary for domestic finance by the end of my time there. That's about 2000 and through the end of 2006. I was in the Treasury in the Bush 43.
Right. And an interesting thing that I read also about that is you received the Alexander Hamilton Medal. I guess it's the highest distinction they can give to someone at the Treasury.
The Treasury is big on medals. On my wall in the office, I've got lucites and flags, and the assistant secretaries and the undersecretaries all have their own flags. So if the Treasury ever goes into battle, you'll know who the undersecretaries are. And the Alexander Hamilton Award, yes, it's the highest award that the Treasury gives, usually just given to Treasury secretaries.
Right. And then after that, what did you do after the Bush 43?
Then I left the practice of law and became an investor, was a partner at the Carlyle Group for many years after that, and then took a group from Carlyle, a group from Liquidity, a place that you know well, and we formed our own private investing firm called Sinosure here in Salt Lake City. Did that in about 2013. And just as I pulled the team together, I was asked to come back to Washington, so I abandoned them and went back as the vice chairman of the Fed.
Yeah. And specifically, you were the first vice chair for bank supervision.
That's right. So the Dodd-Frank Act, the Dodd-Frank Act created part of the analysis, if you will, or at least the conclusion in response to the great financial crisis of 2008 and 2009 was that the Federal Reserve, with regard to its financial system responsibilities as opposed to its monetary policy or payment system responsibilities, was frequently under-resourced. That is to say, there were plenty of academic economists on the Fed board, and there weren't people who were either particularly expert in or specifically charged with the sort of regulation and supervision of the financial sector. So the Dodd-Frank Act created a new position, a vice chairman of the Fed, that would have those specific responsibilities. And the Obama administration was, for a variety of reasons, not able to fill that post, so I was the first to fill it.
That's great. And so, and then you resigned from the Fed when?
On December 24th, 2021, I said that was my Christmas gift to Elizabeth Warren.
Terrific. Okay, so great time at the Fed, interesting time to be there, and then you came back to Sinosure after that.
Sinosure.
So right now, banks are front and center. I mean, there's been a lot of concern with Signature Bank, Silicon Valley Bank, that kind of thing. You obviously have a deep background in bank supervision. How do you think about how that is evolving? What do you see looking forward for the stability of the banking sector?
So I think, one point that I think is underemphasized in thinking about why Silicon Valley Bank, and therefore what's likely to come, is just the consequence of the government policies that basically stimulated the inflation. Really, the fundamental story of Silicon Valley Bank isn't even that it was mismanaged, although it was. It isn't that it was missupervised, although it was. But it was the same story of the savings and loans, which was where I first cut my policy teeth 35 years ago, which is you had a fiscal policy that was excessively stimulative. It was Lyndon Johnson's guns and butter policy that was essentially carried on by the Nixon administration that engendered a great inflation in the country. That in itself increases interest rates. And then when the Fed responds, as it ultimately did under Paul Volcker, that increases interest rates further. And so if you have financial institutions that have particularly illiquid, long-dated, interest rate sensitive assets and highly mobile liabilities, in the 70s and 80s, those were savings and loans, then those institutions are going to find themselves upside down. They will be under enormous pressure. It eliminated effectively the savings and loan industry, which has been folded into the national bank system now. I don't foresee anything as dramatic here, but that's really the fundamental thing that we have seen. And when you understand the fundamental driving cause, you realize, well, that's going to continue for some time. Interest rates are not going to be coming back down soon. The market, I think, is adjusting to the fact that the expectations they had that interest rates might be coming down in September, we can talk more about that in the discussion, but are wrong. I think they're still overestimating the speed with which interest rates would start coming down. They're likely to stay at this level for a longer period of time. And so other institutions in the financial system that have highly interest rate sensitive assets and highly mobile liabilities will continue to come under pressure. My own expectation is that's less likely to, the next shoes to drop are less likely to be in the banking system, because the Fed and the FDIC, the government in general, have shown we will support the banking system through these sorts of pressures. They're more likely to come in the non-bank system, where you will also have institutions with long-dated, interest rate sensitive assets and highly mobile liabilities. It's harder to tell where those are because we just have much less regular and comprehensive reporting from the non-bank system, but they will be there, and some of them will be hanging on now. And as interest rates stay at this level for a longer period of time, it'll be, the fingernails will slip and some will fall.
Rates have come up, on the short end of the curve, 500 basis points. Yeah. And the people that are listening to this, I think a lot of them they rely on banks for construction financing. Mm-hmm. There's an enormous amount of commercial real estate loans that are coming due, something like 25% or thereabouts come due in the next 12 months. As you think about that and put that together with your comments about the banking system, how do you feel about banks' liquidity and also risk appetite to fund some of that maturity need?
So I think inevitably the risk appetite is going to be lower. I think that the liquidity risk for banks, that will depend to a significant part on the supervision of the banks as opposed to the regulation, because the regulations are going to be what they are for some period and they can't really change for, that's a much longer time to change the regulations. But you can change supervision on a dime, and the Fed and the other bank regulators run regular internal liquidity stress tests to determine the resilience of institutions to runs. And currently, they are saying to the regional banks, your funding structure, we now believe, given the failure of these three banks, is more fragile than we previously believed, and therefore you're going to need to maintain a higher degree of liquid assets against those liabilities that we previously thought were reasonably stable. And all of that will be sort of a supervisory push against additional credit extension, as well as the institution's own, sort of pulled in risk appetite, which is, we're not sure what world we're living in.
Yeah. What sources of liquidity do you see coming in to compensate for that, if any?
So principally, I think that the answer has to be central bank liquidity. Since the great financial crisis, the Fed in particular, which is, these are kind of wonky and, maybe overly granular points, but quite important. The Fed, quite differently from other central banks around the world, has said to the banks of the United States, you will have to self-insure your own liquidity completely. And as we evaluate your liquidity resilience, you will not get any credit for the fact that you could borrow from the Federal Reserve. Right? Now, you can borrow from the Federal Reserve, but we give you no credit for that as we determine whether you are resilient. Most other central banks say you have to have a certain amount of your own liquid reserves, of course, and then you have a certain ability to borrow from the central bank. And when we determine what your liquidity resilience is, we take all of that into account. And at the Fed, we haven't up to now. So everybody is aware, I know you're aware, the story that on the last day of its existence, Silicon Valley Bank is scrambling to try to put together collateral that they can give to the Fed in order to be able to borrow from the Federal Reserve, which you would think is kind of a core element of being a member of the Federal Reserve and a bank, is that's the point. You're supposed to be able to borrow from the Fed. That is the original point of the Fed. All this monetary policy stuff are things that have accreted over a century. The only real point is that you will lend to banks when they need the money. And Silicon Valley Bank couldn't, because the Fed had basically given them no incentive to. They've said, you can put collateral with us, you can have a loan agreement with us, we give you no credit for that. So everybody was going to the federal home loan banks for their liquidity because the Fed was disincentivizing being prepared to borrow from the Fed. So if the liability structures of the regional banks are going to be much more runnable than we thought that they were, and that's still an open question, but right now, the system is preparing for the fact that, was this a one-off? Was it something about the nature of these particular depositors, or is it about the nature of the world we live in now that uninsured deposits will be much more runnable? And you were to say to these institutions, you have to self-insure your own liquidity, that's a huge negative push on the ability of those institutions to support the real economy. I think the only answer is that the Fed would say, all right, we will lend to you what's necessary, what you can support. As long as you're solvent, you will have the liquidity you need to meet liquidity pressures that that you're subject to, and we will take your ability to borrow from us into account as we evaluate whether you are sufficiently resilient. The Fed hasn't gotten there yet. It's looking at a lot of what I think are irrelevant changes. They're not necessarily good. They're not necessarily bad. They are irrelevant to the fundamental question of what will increase the resilience of the regional banks. It's the Fed reinvigorating its role as a lender.
And do you see the Fed taking steps so if this arose, they'd be more inclined to extend that liquidity?
So that weekend after the failure of Silicon Valley Bank and Signature Bank, they created sort of a special facility that has some of the features that would be necessary to lend. They said the facility is really just to lend to those two bridge banks now, to kind of further stop the run on those two additional banks. But if they made clear that that's broadly available, which is a practical matter, it is broadly available, it has a 1-year term on it. If they said, no, this is now part of our regular, this is what we do, this is not 1-year term, this is a program that will be available indefinitely. And made clear we can, for these types of assets, we will take them as collateral at par. We'll lend at par because there's no credit risk on these assets. And if they can be held to maturity, they will cover your liabilities. It's just, you may not be able to hold them to maturity, but we can. So we will provide you the liquidity. I think if they do that will be sufficient. And they've done, by creating this facility, they've gotten 20% of the way there, and I'm hopeful that over the course of the next year that they will get the rest of the way there.
So if you went back in time and we're facing the Silicon Valley Bank situation again, and part of their asset mix included a lot of treasuries
Right.
that ultimately would pay off. Would that?
Yes, it should have been part of the Fed's mindset that we can take that as collateral and we will lend you the full amount of the money. Since the 19th century, central banks have followed the injunction of a sort of banker and writer of the 19th century called Walter Bagehot, who said what central banks do in a liquidity crisis is that they lend against good collateral at a discount and at a penalty rate. And that's usually good practice. But for these particular assets, in this particular circumstance, there's nothing that's written in the laws of the universe that you must do that. And for these particular assets in these particular circumstances, I think the Fed should say, well, there's no reason we can't take those at full credit and with less of a penalty rate in order to address these particular circumstances.
Right. Interesting. Okay, so one of the things I love about your background, right? You've been an advisor, you've been a regulator, you've been a business operator, you've been an investor in assets. I mean, you kind of look at this potential issue from kind of every side. So if you put yourself in the shoes of somebody who is a commercial real estate, owner, what takeaways from the situation with Silicon Valley Bank and the current position of the regional banks and banking structure in the U.S., what takeaways would you have for that?
With respect to the banks, the takeaway that I've had, it's the advice that we've given to our portfolio companies over the, since this all developed, is, the government, the system, the bank regulators, they're not going to allow significant losses to depositors, right? So to the extent that you have, deposits with the system because you have loans with the system, those are not seriously at risk. So we had portfolio companies before First Republic's failure that had exposure to First Republic. Our advice to them was, First Republic could fail, but you are not at risk, which is what happened. And similarly with any of the banks with which folks have business relationships. I think the second takeaway, though, goes back to that first fundamental point, which is, this is being driven by the interest rate response that's necessary given the inflationary impetus, and that will continue to run its course, and that takes longer. It's not going to be over in 2 to 3 months. And so interest rates will be at this level. I don't think they have to go much higher. My former colleagues at the Fed have indicated they might have some more interest rate increases. I don't think that's necessary. At the end of the day, I don't think there will be the 2 that people expect. That's come from looking at the so-called dot plot after every other FOMC meeting. Every member of the 19-member committee fills out a form, I guess I should say. I was about to say makes a projection, but the whole point is that they aren't really projections. They fill out a form as to, expectations about interest rates in the near term and over time. And those are not really filled out by throwing darts at a board, but neither are they sort of an expression of the consensus view of the committee as to what's going to happen. So the fact that those dot plots in the last after the last meeting showed kind of a majority of the committee projecting 2 additional interest rate rises, you need to attach a significant discount to whether, in fact, they are really saying that's what they intend to do. So I think interest rates are about where they need to be. They just will need to stay at this level for a much longer period of time than people have been thinking. Consider back to the Volcker response, right? I mean, these were interest rates that were hugely swinging. I mean, folks of my advanced years remember first mortgages that were 14, 17%. These were much bigger interest rates than we have currently, and that took years to rein in that inflation. That did not happen over the course of a year and suddenly inflation was back to normal. It took years. Now, I think there's good reason to expect that the time frame now will be less than it was in the early 80s largely because of advances in central bank communication central banks around the world, the Fed in particular, is much clearer about what its future policy is going to be, so people can react to that more quickly.
Yeah.
And so I think that time frame is likely to shrink, but it's unclear how much it's going to shrink. And if you shrink something down from 3 years to 1, that's still a long time. We've still got a long ways to go.
Going back to the dot plots after
Yes.
the last Fed meeting, it started to show some rates coming down in 2024 and again in 2025. Where would your dot plot be?
I think that rates can start coming down towards the end of 2024, but it's unlikely to be before that. You're going to have to see. Part of the reason that people think that rates will come down sooner, most of the world has not lived through a previous tightening cycle, a previous effort by a central bank to constrain a very significant inflation, and they say, well, this interest rate policy is likely to tip the economy into recession, and central banks respond to recessions by lowering interest rates.
Right.
Well, yes, central banks respond to recessions by lowering interest rates in normal times, but when they are trying to constrain a generational unique inflation, a recession is not a bug, it's a feature. It's part of how you do it. So you're trying to slow the economy. It's almost impossible to slow that perfectly so that you don't tip into the negative. And so you won't start lowering interest rates because you've gone into recession unless you see inflation also significantly coming back down towards your target. If inflation is still well above your target, then the recession is just part of how you're going to get to your target.
So a question about that, right? The Fed has been very clear about this 2% target.
Yeah.
Is that the right level? I mean, could or should the economy tolerate something higher than that? What's your opinion?
So the 2% target comes from sort of a fourth grade math. There's nothing particularly esoteric or rocket science about the 2% target, which is, at the time that the Fed articulated the 2% target, there was a general belief, I think it was probably correct, this was under Bernanke, that the sort of real rate of interest, the rate of interest in a world that had no inflation, would be 2%. The Fed also believed that history had taught it that in order to respond to downturns in the economy, it would need to be able to turn down short-term interest rates by 4% to really make enough of a difference. Otherwise, it gets into the trouble of, you hit the lower bound, you don't want negative interest rates, you have to start doing weird things to try to continue to provide accommodation. So they wanted a 4% interest rate to turn down. If you think the real interest rate is 2%, then to get that 4% rate, you have to have inflation of 2%. It's just 2 + 2 = 4. It is as simple as that. Now, there's a lot of academic work, a lot of policy work around the view that the real interest rate now is much lower. So the person who thinks most about this at the Fed is the president of the Federal Reserve Bank of New York, a guy named John Williams, who has risen through the system. He began as a economist on the board, and then was the chief economist at the Federal Reserve Bank of San Francisco for a long time. And over that whole time has thought about this concept of the real rate of interest. His estimate is that it's quite low now, call it 0.5%. Well, just going back to that fourth grade math, if the real rate of interest is 0.5%, and you think you need 4% to have an effect to be able to turn interest rates down, then you ought to have an inflation target of 3.5% now.
Right.
Now, the reason the Fed has not re-articulated that is that at the same time, there's a concern that a big driver of inflation is in the expectations of the populace about inflation. And that if you had an actual target of 3.5% inflation, people would say, that feels to me like you don't really care about inflation. That's kind of high. And so if you don't care about inflation, then you, instead of re-anchoring inflation expectations at 3.5%, you've essentially just unanchored them. And people say, I got to protect myself by getting raised. I need to make sure that my wages are increasing, and that drives further inflation. And I tend to agree with that latter view. I think that 3.5% is too high a target. And I think the bulk of the Fed currently believes that as well, that 3%, although it could be justified by the analysis that created the 2% target, that it's just too high. And so the other thing that's relevant to that analysis is that the Fed just reaffirmed its 2% target in August of 2020. So for the many central banks around the world have a regular every 5 years review of what's our inflation target, how do we achieve that inflation target, how do we think about the relationship between unemployment and inflation, between output and inflation, just what's our framework. And the Fed did that for the first time, really, in a comprehensive, very public way during 2020, and emerged in August of 2020 saying, we've rethought some elements of our framework, but this core inflation target we're reiterating. And if so quickly after that, the Fed said, 3% is probably close enough for government work. We did say we're going to aim for 2%. Then 10 years from now, when there's another big inflation and the Fed's target is now 3%, and they say we're going to bring inflation back down to our 3% target, there's too much risk that the world would say, well, last time you said you were going to bring it down to the 2% target, so why should we believe you?
Right.
So I think the Fed is really put into a position where, both because I think 3 or 3.5 is too high, and because for its own credibility, it just reiterated the 2% target, it's going to have to get inflation down much closer to 2. And then in 2025, when it says now is time for us to rethink our framework, it can consider whether that 2% is the right target or not.
That's a very helpful answer. I've certainly learned a lot there. So as you think about that, with that in mind, and as you look forward to the conditions where the Fed may start to lower interest rates, and I know the Fed kind of focuses on PCE, what kind of readings would we need to see in PCE before you think the Fed would start to say, well, maybe we can?
I think you need to see core PCE below 3, and at the same time, a significant adjustment in the various measures of labor market pressure that sort of indicate an upward pressure on wages. So right now you have a very low unemployment rate, you have a very high vacancies rate, you have a very high quits rate, you have a low labor force participation rate, and all of those together lead to a very tight labor supply. And they can adjust themselves in various ways to relieve that pressure. You could keep a very low unemployment rate and just have the vacancies rate come way down and say, all right, the upward pressure on wages is okay. We had a very low unemployment rate just before COVID, and had very little inflation.
Yeah.
So, but however they realign themselves, you need to see them realigned in a way that relieves significant amount of pressure, upward pressure on wages, at the same time as the inflation rate itself has come down probably below 3%. And then the Fed could say, all right, now we can start thinking about lowering interest rates and bringing the plane in for a landing.
Right. So as you think about the labor market, right? In my simple way of thinking, a lot of it's supply and demand of labor. What role should immigration policy, in your view, play here in terms of shaping the labor market?
So I've always thought that we should have, a immigration policy that emphasizes sort of the import of skilled labor. And we have an immigration policy that sort of just is completely diverse of that effectively, because we have very poor enforcement of our immigration policy. We have significant disincentives for the immigration of skilled labor. And I think just in general, government policy is better, and immigration policy would be better if we had kind of clear, sensible rules that we then felt comfortable and confident in enforcing. We've benefited enormously over the life of our country from immigration when that's been sensibly calibrated. And right now we're kind of doing exactly the opposite of what we ought to be doing.
Right. Okay. Thank you. So as just taking a step back again on the concept of a recession. Mm-hmm. What do you see? What do you think the probability is that it happens? How deep? How long? What are your...
So, I think the received wisdom about a recession is probably right, which is that there will be one, and that it will be, as these things go, relatively short and shallow. Maybe not as short and not as shallow as it might have been had we not continued to pour fiscal stimulus into the economy, even as we realized that we were creating this gigantic inflation. But nonetheless, the fundamentals of the U.S. economy really are very strong, certainly when you compare that to the rest of the world. And so the opportunities for kind of economic dynamism in the United States are very great. I think that that interest rate policy, given the drivers of this inflation, interest rate policy will be very effective. This is principally a demand-driven inflation. We overstimulated demand. A central bank can rein in that demand. It takes time, but it will be successful. And you get to the other side of that, and you have a growing and fairly strong economy, fairly well-structured economy. But it's very unlikely that you could constrain an inflation of this size without the economy going through a brief recession. The Fed, and people have talked about this a lot. They seem to talk about it every time that the Fed is reining in inflation. The Fed has almost never brought in inflation, particularly a sizable inflation, without tipping the economy into recession. So I have no idea why we would expect it would be different this time. Jay's a great guy, but and the people on the committee are smart. But if it's never been done before, I wouldn't bet on this being the one time that it happened.
Right. And if that comes to pass, you use the word brief to describe it. What does that mean to you?
The technical definition, although we went through that weird episode a year ago where everyone was arguing about what the definition of recession was, but the definition of recession is that you've got 2 quarters of negative growth, and I wouldn't expect it to be longer than that. So the question really is just what's the depth of it. And again, we're not talking anything like the Great Recession from 15 years ago.
Right. A lot of people listening today rely a lot on the agencies, Fannie, Freddie, also HUD financing and so forth. What's your view on the future for those entities and the role they play in finance in the United States?
So, there was a period in my life, in the early 2000s where I was sort of one of the principal people at the Treasury charged with what was supposed to be policy towards those entities. And if in my perfect world, those entities would not exist. Most countries don't have them, and they have perfectly vibrant housing sectors. And I think they, create the potential for a lot of pathology. I think that the Republicans have to accept that they are going to exist. They will not be legislated away, and we've had further and different pathologies by allowing them to kind of remain in this existential limbo for 15 years, essentially owned by the government. I think that, and I do believe that we will get to this point that they should continue to exist. They should be split back out from the government. The subsidy that they receive should be charged for, so to put them more on a level playing field, and then we should move on. We should give up trying to erase them, and we should simply say they have a function, they have a cost. That cost should be covered by their fees, and then we'll let the system evolve from there.
Okay. So, given your experience, across your career, right, and coming out of the Fed, what are the main lessons that you've learned that have applicability now to in your role as an allocator of capital and businesses that you invest in? What are some of the most important lessons you've learned?
Well, so the most important kind of short term, what's relevant for now is to realize that interest rates are going to be higher for longer, and to make your investment decisions keeping that in mind as we think about our investments at Cynosure currently, our private equity investments significantly, but other types of investments that we make. It's very much the view of, prices will be coming in as people realize, oh, this is going on for longer than we thought. Public equity prices will readjust over the summer, in my view, and private asset prices will readjust, in the second half of the year, as people accustom themselves to the view of, oh, this is how the world is going to evolve. So from my experience, I take that kind of short-term, immediate lesson. I think the longer-term lesson is, I got a note recently from a retiring CEO of one of the big banks in the country, who emphasized what I think was the fundamental lesson. He was sort of going over what he thought, the lessons he had learned from a long career, and he thought it was similar to what I had tried to emphasize when I was at the Fed, which is, you should focus on what's really important. And it is very easy to get distracted or overwhelmed with a whole lot of things that are kind of important or interesting, but you can't lose focus on what's really important. And we could go through a lot of war stories about that. But again, going back to what we began with, I do think that we are in the situation we are today because the fiscal authority of the government lost track of what was really important, which is you can't put $7.5 trillion of stimulus into an economy over the course of 2 years without generating inflation that's going to break a lot of things.
Got it. Great. Any parting words of wisdom to real estate investors in the U.S.?
I guess the parting words of wisdom would be that while the transition here is obviously difficult, because we're moving from a period where interest rates were very low for a long period of time, and now they've sort of just been jacked up by a huge percentage amount in a short period of time, that over the medium period of time in the future, your investments are existing in a country with enormous dynamism, right? And so as long as you ensure that you've got the wherewithal to live through the transition, this is a terrific place and time to be building infrastructure, to be investing in infrastructure, to be making long-term bets on America. I would do that all day long.
Terrific. Thank you very much for joining us today, Randy. We really appreciate it.
Thank you. It's
Thank
great
you.
to be here.
Yep.